All right, guys, welcome back to my channel. I'm excited to do this video for you guys where I'm going to go over my quick multifamily screener tool. This is a tool that I use to screen all my multifamily deals that are value add typically, but this will quickly give me an answer of, is this something I'm interested in? What's going to be my general strike price? And it's just a great way for me to quickly filter through a lot of deals I look through. So really quickly, I'm going to give you guys an overlay of the tool and then we'll go right through it. So there's obviously this welcome tab here where I give you guys an overview and then some instructions about each summary or about each tab. Then we have our projections and summary tabs. This is where we're going to enter all of our projections, income and expense, our cap rates. We even have a refinance table right here as well that we'll go through. Year 2 to 7 projections. You don't need to do anything here. This will automatically calculate itself. This is going to be income, basically a P&L projection for all the years 2 through 7. And then finally, there's going to be a debt amortization tab. Again, nothing you need to do in here. Everything will come out of the first assumptions tab, but you can see we have the loan amounts, amortization periods, and it'll basically give us a full, debt amortization schedule. And one quick note too, you'll notice here when starting out, there's zero principal payment. This is because this tool also accounts for interest-only periods, which I'll talk about. It is, that assumption is currently turned on. So that means we're only paying interest and not principal. So that's why it's turned on. That's why it looks like that. But now, before we jump into real quick, guys, if this is your first time on my channel, really quickly, make sure you guys please subscribe to the channel. I'm putting out videos like this all the time, talking about all facets of real estate investing, construction, deal analysis like this. I give you guys project stories. So if that's the kind of such content you're looking for, make sure you subscribe. And with that, let's get right into it. So we go right into this year 1 projections and summary tab. Again, this is going to be the main tab where we're going to enter all of our assumptions. So let's start right from the top here, right? So this is our basic P&L. And real quick too, all cells colored in yellow are the only cells we really need to be editing. Everything else will kind of calculate itself. So start with number of units, right? So in this case, I already have plugged in a deal I was looking at a short while ago. It was a 6-unit deal that was asking 1.6 mil. So we're going to put that right in. Closing costs, depending, this is probably a little high. You can, depending on what your closing costs are, you can input them right in here and get your closing costs. We have a liquidity and, this should say soft cost, not caught. Liquidity and soft cost line item. Basically, this is a line item for how much soft costs we're going to incur while we stabilize the building. And as we'll talk more about too, this model and this whole strategy here basically assumes that we're going to be raising private capital from investors, right? And we'll get into doing the return analysis for them, but all these items are important to calculate because we want to know if we need to raise money for our closing costs, if we need to raise money for our liquidity and soft costs. Now, for repairs, we assume that those are going to be bank funded, and typically 100% of the proceeds will be bank funded. Now, you'll see here on one column I have 0, and one column I have 120,000. If you'll note, my column D here is a current pro forma, right? So this is current numbers, whereas column E is my stabilized operations column, right? So, basically what we're saying is, hey, what do the numbers look like today? And obviously we are, in this scenario, we have not done any repairs. That's why it's 0. And then, hey, what happens when we take this money, spend the money for repairs? What do our financials look like, right? So that's why you'll see this discrepancy between 0 and 120,000. Next, we'll do down payment, right? So this is pretty straightforward. You'll put in your, percent down payment that you think you can get from a bank or a lender. So in this case, I did 30%. Acquisition loan amount will calculate itself. And then total equity raise, right? So total equity raise is going to be, if you look at the formula, it's going to add up our closing cost, our liquidity soft cost, and our down payment, right? So that's basically all the equity we're going to raise for this deal. Next, we're going to go to bank note, right? So this is our debt. Now, here we go. The first assumption is interest only year 1. So you can select yes or no. If you do no, then, basically you're not going to have, you're going to make full amortizing payments year 1. Usually we get 12 months interest only, especially on value add deals. So that's why it's typically yes. Then really the only other assumption you have to input is the rate, right? So today's commercial rates are going to be over 7% from local community banks. So you're just going to input that. Next, we're going to do income, right? So this is basically where we take all of our units and input our income assumptions, right? So this is going to be our current income assumption. So, if this is whatever the building is, generating today, this is the current rent roll. And then we're going to put in our stabilized rent roll. Like, what do we think we can push our rents to? So, if current rents are $19.50, if we do the renovations, we think potentially we can push them up to over $2,500 per month per unit. And then we're going to have an other income line. So, parking, laundry, storage, anything like that you might be collecting from the property, you can input here. And that will get us to our gross total income number. Next is going to be our operating expense number, section. So this is where we're going to put assumptions for all of our operating expenses. So starting with vacancy, typically we do 5% of gross collected income. That's, you can obviously change that depending on your market. There's some sub-markets in Boston where I do 4%. It just really depends on you. Property management. So if you're going to pay a PM to manage the building, again, my PMs today, I give them a lot of business, so I get 5%. Some of you might need to pay 6 or 7 or even 8%. So just put in the correct assumption for you. Repairs and water and sewer, we typically do by line, per unit basis. So, repairs, $90 per unit per month, water and sewer, $70 per unit per month. And you can see all this does is just multiply it by the total number of units, so 6. So that's how we're getting our repairs and water assumption. Common electric, you just put in whatever the assumption is. It's usually pretty low. Again, snow, especially if you're in the Northeast, you'll want a snow line item. Turnover costs, this is kind of turnover and broker commissions. These are line items that I've started to input, essentially making assumptions for units, basically our cost for when we turn over units, as you would think, right? So, in a 6-unit building, I would assume maybe we only have one move out per year. So basically what I did for the turnover, you can see I did 1,000 divided by 12. I said, okay, well, let's just say I have one turnover per year and it's going to cost me $1,000 to turn it over between, paint, some fixture replacements, whatever, right? So that's how we came to this number. Again, if you have more units, or if you think you're going to have more units turning over per year, you're going to want to obviously increase this line item. And then same thing with broker commissions. Obviously, every time we turn over the unit, we have to hire a real estate agent to rent out the unit. In this case, you can see this should actually be 25. So basically, I just did kind of a soft assumption, where I said 2,500 is the rent that we're going to charge. Typically, a lot of times tenants will pay the broker fee, especially in a competitive marketplace like Boston. But just in case, I basically made the assumption that we're going to pay half the broker fee half the time whenever we turn over units. Again, if you wanted to get more conservative, you can say, well, what happens if we pay the broker fee, half the time, all the time? So again, this just depends on your marketplace and how confident you feel in, being able to not pay the broker fee, right? Pest contract, you can also change this if I'm missing a line item for something else, maybe trash, or, if you're paying for trash for whatever reason. But pest here, I threw in a little bit of a line item. And then taxes and insurance. Taxes and insurance is important. Obviously, so taxes, this is today's number. One thing I would encourage you to do on the stabilized tax number real quick is, what I would do is actually, instead of using today's assessment, what I would do is actually say, take today's purchase price, right? This is our Boston City tax rate. And usually we get reassessed. We usually get reassessed on a new purchase, right? So usually in Boston, I've seen anywhere from 80 to 85% of a reassessed value, right? Because basically this is based on today's assessed value. But when a property trades, there's going to be typically a reassessment, and usually your tax bill will increase, right? So you don't want to map the same exact real estate tax bill on your stabilized pro forma. because again, more than likely that number is going to change for you. So that's actually a very key tip. Next, we have our NOI basis. So we have our total monthly income, we have our total monthly operating expenses, and that gets us to our NOI. This is just a quick check of our operating expense ratio. So, for most small multis, you should be somewhere around the low 30% range. So this checks out really well. This seems to be right on point. Next, we have our debt. You can see the difference here. In the reason why we have two different numbers is, remember, we have interest only the first 12 months. So that's why we have an interest only payment. And then we have a full amortizing payment. So that's the difference. And then finally, below the NOI, we have the monthly CapEx line item. Again, this is a per unit per month. So this is going to multiply this times 6 to get the 240. And finally, we get our cash flow per month with annual cash flow and debt service coverage ratios, right? Which are obviously really important, for banks. And we end this with a cash flow and a per unit summary, right? So we can see our total cash contribution. So this is the total equity we raised. This is the total monthly cash flows, total cash on cash return, and then a per unit price acquisition and a per unit cash flow summary. So nice little summary showing our, on a cash flow basis and a per unit basis, how this deal quickly pencils. You can see this is actually, for Boston, this is not too bad. 4.5% cash on cash. Honestly, it's pretty solid if I have to be honest. So this is pretty solid. Now let's move over to property purchase and ARV assumptions. So here we want to know if we're going to be doing, especially if we're going to do construction work, we want to know if we've created equity, right? So you can see we take our purchase price, which it pulls right from our assumptions. We take our hard construction cost, which again, it gets pulled from over here. Our soft cost also gets pulled in. And we want to figure out our total all-in cost, right? So our total all-in cost is 1.736. Then we want to look at the market value when this building is stabilized. And we'll get to how, I'll show you guys how we determine this. But, in this case, we penciled it out to just over $2 million, which means we created about $280,000 of equity, or about 14% margin, right? Which, again, in Boston, pretty solid, right? I mean, those are numbers that I would typically be, pretty interested in. Now, I did a quick NOI and cap rate table just to guys, just as a summary. So you can see what our stabilized net operating income is, so you get a feel for it. Now we have our as-is cap rate, so we know our going in cap rate. So this is, again, based on today's financials. We want to know what's the going in cap rate. And then we did the yield. We have a yield to cost metric, right? Which is a nice metric. And if you look at the formula, basically what it's doing is saying, what is the stabilized NOI compared to our all-in costs, right? So our construction and our soft costs and our hard costs, right? So it's basically showing us, how much yield we're creating by, through our stabilized NOI by doing all, this whole project, right? And in this case, you can see the yield to cost is obviously significantly higher than the as-is cap rate. It's over 1% higher, which is pretty good for a value add deal. New construction, we would want higher spread, but on value add, that's pretty solid. So next we have our ARV table. So this is how we calculate our back end value. So there's two ways to determine value, right? There's the comp method, and then there's the cap rate value, right? So I'm actually going to start with a cap rate value. And with cap rates, what you're going to see is essentially what we want to know is, okay, what should this cap rate be for this kind of product, right? So, you should know this based on the location of your building and the type of building you're dealing with, what kind of cap it will trade on the back end. If you don't know, you can talk to brokers, other investors, or even lenders, and they can kind of give you a sense of what the cap rate is. And then what I usually do is I kind of do a table where I go a quarter a point above and a quarter point below, just to kind of get a value range, right? So this is going to be my base value. If I think the cap rate's 6.25, this is going to be $2,019,000. And remember, that's how we get our market value when stabilized. But, I kind of want to range, all right, it could, generally fluctuate from anywhere from let's say 195 up to 2.1 with kind of a base value of just over $2 million, right? And then if we wanted to also do a comp method instead of a cap rate based valuation, right, where we just did like comps, we can do that here and we can input whatever number we wanted to. In this case, I have it equal to the cap rate value because it's a 6-unit building and I don't really care about the comps. But let's say I was dealing with a 3-unit building, I could always input a different value into here, change that up, and see if it's different than the cap rate value. Next, we have some market growth assumptions, right? So with our market growth assumptions, we want to make a couple of assumptions. We want to know what the annual appreciation rate is, and then we want to know the income, operating expense, and capital expenditure yearly growth rates. Now, the reason these are all going to be important is if we're doing our back end value, or ARV, on a comp basis, then this is going to be an important metric because this is what we're going to grow out the comp, right, on a year-to-year basis, right, because we want to project the value into the future. So we're going to say, oh, our comp is going to grow by 3% every year. But if we're doing an NOI valuation, we don't want to do that. Instead, we want to do an income and expense growth, right, because we're going to have an NOI-based calculation. So we want to basically grow out our income and expenses so that we can grow out our NOI, and that will allow us to come up with the right valuation on the back end. Now, this is our return metrics for our private capital. So let's just actually say private return metrics for private capital. Whoopsies, there we go. So first, the assumption we want to make is how much percent ownership are we giving to our private capital in exchange for the equity that we're raising? Let's say we're kind of going typical 70% ownership to the capital partners and 30% to us. Next, we want to make some assumptions about selling costs. So selling cost is going to be 4% on the back end, right? That's typical broker fees, some closing costs, etc. Then we want to select a method for valuation. Again, remember we talked about whether we're doing NOI or comp based. Since this is a 6-unit building, I will keep it as an NOI basis. But if I wanted to, I could select comp growth, and it would project out the value of the building using the annual appreciation rate. So you can see value at sale, boom, NOI growth. You can see they're actually a little bit different, right? They come out a little bit different because we're growing out income rather than just doing an annual appreciation rate. But anyway, we have our NOI growth right here. So that's the value at our sale, so 2.14, right? And now we can break down the return metrics for our investors. So we have a quick table showing the cash flow. So they're going to invest, $530,000 up front. This is going to be their cash flows year 1. This is going to be their cash flows year 2. And then year 3, this is going to be their profit, right? So this is going to be the return of the equity plus all the profit they made. And we're going to basically pencil out an IRR and an equity multiple for our investors. Now, not going to go super deep into what these mean. I've done other videos on these. I will say for value add deals, we typically look anywhere from around 15 to 18% on IRR. So this is not too bad. It's basically getting there. For an equity multiple, being under 1.5 is maybe a little low, not amazing. I would maybe like to see it somewhere around 1.6 to 1.8 ideally. But it's not bad. I mean, we'll have to maybe adjust the price a little bit, but that's not too bad. And then we can, I did a breakdown of sale proceeds so we can clearly see how the sell-off goes. So, you're going to have your building value at sale. You're going to have your mortgage balance at sale. You're going to have closing costs, net gains, additional cash flow. You'll see the total total proceeds to be dispersed. We're going to pay back our guys the $530 that we raised. So total net profit is going to be $330. And then we're going to split that based on our percent ownership between our equity investors and us, the operator. So we're going to make $100,000 in proceeds. Finally, on this page, I did a quick refinance tab or a refinance calculation tab where you can kind of just see if there's going to be a cash out refinance play, right? So basically, we want to see, if let's say we wanted to refinance in year 2, right after we stabilized it, we can see what our ARV is going to be at that point at year 2. So it's going to extrapolate the value. Again, remember, we said it's 2.019 right here. It's obviously grown after owning it for a little bit to 2.08. We're going to play around with the LTV of the refinance loan that we want to take out. So let's say we wanted to do 70%, right? We'll know our new loan amount. Our outstanding debt is going to be pulled in. So this is going to be our outstanding mortgage balance. And this is going to be the amount of cash we pulled out, right? So this is going to be $216,000. And this is going to be the rate of the new loan that we're going to assume. So, right here, it's going to summarize this, right, for us. So, we raised $530,000. Let's say we cashed out $216,000. We still owe our investors $311,000 because we basically returned 41% of the equity that we raised on the deal. And very importantly, we do want to look at the DSCR on the new loan, right? Because this number cannot go below 1.2, right? So for example, let's say I did the rate, we increased the rate to 6.5 because let's say we weren't sure the rates were going to go that low. Well, at 6.5, all of a sudden I can't pull out the same amount of cash because now my debt service is below 1.18, right? So, I would need to adjust the LTV to 68, right? And now I have a 1.21 debt service, so I should be able to pull out this amount of cash. So that's just a great quick way of seeing, like, is there a refinance play, right? When we do the sale calculations here, we are assuming that we are not refinancing and we're just, doing the stabilization and then selling off the building. So that's kind of it. That's the summary of how we calculate everything. So you can see we calculate everything from cash flows to the building at a high level. We calculated our investors' returns for, and see if we can raise the money based on the return profile. We saw how much equity we created. And then we also saw, is there a refinance play here for us to potentially pull more money? And then as a reminder, again, we don't need to do anything on this next two tabs. Everything gets adjusted automatically based on the assumptions that we change here in yellow. So that's really it, guys. Hopefully you guys got a ton of value from this. It's a great tool. And obviously I'll have this downloaded, this tool as a download if you don't already have it for free. So I hope you guys enjoyed the video.